We feel that the consulting community doesn't really spend a lot of time in that area. They really can't scale those types of investments across all of their clients, so it's just not worth their time. And any sort of eclectic or lumpy return stream is also repugnant to them because they need to sort of answer to a committee. The committee is going to be putting you in front of a risk committee if you're out of step for a certain extended period of time. So the audience for these types of funds and managers is not going to be through some of these larger platforms. And I would say even some of the smaller and mid-sized platforms have gotten to the point where they don't want to have to explain, yeah, this manager's done exceptionally well over a long period of time, but he's in the top quartile for these 2 quarters, and then he's in the bottom quartile for these. So I have to spend time away from my business explaining these 2 bottom quarter performance returns. So it's been sort of a gravitation towards a smoothing or a less lumpy return stream that has been attractive to some of these larger institutions. We believe that there's a growing investor base that is looking for longer term outperformance and can stomach those periods of underperformance. I mean, I think Joel Greenblatt says that it's the only reason why value investing works is because there are periods that are prolonged sometimes and cause fatigue where it doesn't work. And if it worked all the time, it would be arbitraged away, but it doesn't. So there's a human behavior of pulling the plug when things aren't working. We're seeing a period of that now that's been probably an anomaly in terms of it appears as if growth and momentum has been the only place to be over the last 8-9 years, and value has been left for dead. Very much reminiscent of the late 90s when everybody thought Julian Robertson and Marty Whitman lost their minds. It's a dinosaur, and it's no longer going to work. Well, 2000, 2001, 2002 were outsized returns when the pendulum swung towards value, and it's just naturally that securities that are mispriced and assets that are cheap do not stay cheap forever. And there's going to be a buyer, whether it's the market figuring it out or a corporate or strategic buyer. So you start to see more share buybacks, you start to see more M&A activity, you start to see more privatizations, or what Marty Whitman would call resource conversion activity. And we actually went back and looked at Marty Whitman of Third Avenue's returns in 01, 02, 03, and virtually 60% of those returns came from these types of resource conversion activities. So we've sort of come through this period, and I think we're starting to see a bit of a shift, but it's not easy. Value investing is not for the impatient. You're really going to have to take your lumps, but we're not changing our stripes.